Oil prices are moving higher with energy stocks getting a lift as a result following OPEC's production cuts. Energy traders and economists are now analyzing the motivation for the cuts. Was it a power play by Saudi Arabia or a signal that the group of oil-producing countries see weakness in Chinese demand? Joining us now to discuss is CIBC Private Wealth U.S. Senior Energy Trader Rebecca Babin. Rebecca, always a pleasure to have you here with us and get some of your insights on this. So perhaps you can help us start there. Was it just a power play, or was this a broader demand story?
So that is the question the market is currently grappling with. And there's kind of two schools of thoughts, as you mentioned, that they did this in response to what they see coming out of China as a weaker demand profile, whereas expectations are very high for Chinese demand throughout the course of the year. And that the U.S. recession will be deeper than many have kind of projected. The second school of thought is that they saw the price action in March where you had a 17% sell-off followed by a 12% rally and realized the market had succumbed to financial market players dictating price action and price action moving away from fundamentals and more to financial instruments. And they really dislike that. So my thought is that this move is a combination of both. Primary driver, I believe, is a response to the market action they saw in March, where short sellers really dictated pricing, where fundamentals actually still remained fairly solid. And this is something they've really talked to in the past, particularly Saudi Arabia's energy minister. He has said, I want to make the shorts ouch like hell. This is a thematic kind of narrative throughout all of his press conferences. So I think that was primary. Secondary, I think this macro event has led to higher uncertainty about growth. And there is probably some concern from their end that demand might not end up being as strong. So they kind of killed two birds with one stone on this surprise move. I think the primary driver was taking the market by surprise and reminding everyone, especially the short sellers, they are in charge.
All right. We know this might have been an attack against the short sellers. There could be a response from the U.S. administration as well. Just wondering what cards, what quivers are, I guess, what arrows are in the quiver of a Biden administration at this point. You still have barrels in the Strategic Petroleum Reserve, although there have already been calls to replenish that from the previous drawdowns. There have been some measures about drilling in federal lands. Those haven't gone anywhere in the last couple of years. Just wondering, what is I guess, not only the jawboning that could be done, but actual measures that could be done in the U.S.?
So the jawboning, if you notice this time, is very different than the response from the U.S. is very different than what we saw when they put forth their cuts in October of 2020. The U.S. administration really responded aggressively to that. Obviously, it was part of a midterm election cycle. And this response has been a little bit more muted. I think that there will be continued comments that, as we saw from Janet Yellen, saying this was not constructive. And I think that will continue. I don't think it gets much more aggressive than that at this time. And I think the reason for that is they didn't get any results from really doing that. They had really pressured, except to weaken the relationship with Saudi Arabia, right? They jawboned, they took this very aggressive stance. They didn't get any response from Saudi Arabia to bring back production. So they're realizing that doesn't work. Maybe they need to be a little bit more collaborative and offer something else to try to get maybe production back online. So that strategy didn't work. I think they're going to use the media, obviously, to project that they don't like this, but I don't think they take it to the next level. In terms of their tools, you said something very important. They can release more from the Strategic Petroleum Reserve. That is essentially their tool. They have already released a lot. It's getting to levels where we haven't seen since the 1980s. It would be controversial to do so. So I think they will really try to avoid doing that over the course of the next several months, but it's not out of the question. And just keep in mind, we actually currently have an SPR release coming over the next 3 months, 26 million barrels. So they are still, that was, pre-slated prior to this fiscal year, but we do still have SPR barrels coming into the market over the next couple of months.
Rebecca, even as we kind of look back at the stress that kind of permeated into the start of the second quarter and as seen through Jamie Dimon's letter this morning about the banking crisis and what that means for the surprise that could happen, or the big surprise that could cause the markets stress or the economy stress in the second quarter, or even later on this year. Did that surprise just happen? Did this OPEC decision, was that the second quarter surprise that is ultimately going to be the stress factor for the macroeconomic scenario and seeing that plays out from this point forward through the rest of the year?
That's a tricky one. So I would say no. And the reason I say that is the reason that higher crude oil prices last year resulted in above $5 a gallon gasoline at the pump was because we had very constrained refining capacity. This year, we have refining capacity globally coming back online. So there is a little bit of a release valve, at least to a certain extent, that higher crude prices might not kind of compound into extraordinary prices at the pump. So because we have a little bit more refining capacity online, which helps the kind of impact of higher crude and not having as much of an effect on the consumer. However, I think if we get to points where there's a vacuum higher and crude goes above $100 a barrel, we could see obviously more reaction function from the Fed and a much more kind of impact on the economy. I don't think that's what Saudi Arabia is playing for. I think they're smarter than that. They will now have barrels to bring back to buffer, and I think they will be very, very fast to do so in the event that you get a price spike above 100. That is not good for them. It's not good for us because it ultimately kills the demand that they want to continue to see and stabilize. So I don't see it playing out that way. But it certainly is something on the risk horizon that everyone's thinking about and talking about. So it's not, you shouldn't just brush it under the rug, but I don't see it playing out.
Duly noted. CIBC Private Wealth U.S. Senior Energy Trader Rebecca Babin. Rebecca, thanks so much for the time and insights here today.